Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is Michael Pento, president of Pento Portfolio Strategies. Michael, thank you for being here with us today.
Thank you for having me, Jason.
Now, Michael, we had Ben Bernanke today speaking to Congress, and it seemed Ben was definitely, right back at the desk there trying to manage inflationary expectations, despite what he said about 10 days ago earlier, how he wanted to keep interest rates low through the end of 2014. Do you think the Fed and Ben Bernanke are trying to keep this balancing act here, where they create monetary inflation, but they also manage the inflationary expectations and velocity of money so inflation doesn't get out of hand?
Well, I think Bernanke is a little bit confused and perhaps schizophrenic. And at one point, he's saying that he wants to have a target rate for inflation of 2%, and his metric of measuring inflation is his core PCE, which is running at about 1%. So inflation, according to Bernanke, is running well below target. And you'll notice that, and remember that core PCE has an inflation rate that's far below what the actual rate of inflation is, which is running closer to 6 to 8%, depending on how you calculate it using pre-Boskin calculation methods. So at one juncture, he's saying he wants an inflation target of 2%, which is higher than what it is, and at the same time, he's in his press conference saying that it might have to go higher than 2% in order to bring down the unemployment rate, never mind the fact that the higher the rate of inflation, the higher the unemployment rate usually becomes. And then he has this protracted period of time where he's going to start raising interest rates. Now, interest rates are now 0%, and they were 0% now for 4 years. There'll be another 2 years before they start to rise, so there'll be a minimum of 6 years where we'll be at 0. And I don't think Bernanke or anyone else believes that Bernanke is going to aggressively raise interest rates whenever he starts. He'll do it in incremental baby steps, probably quarter-point increments after every meeting. So we're probably looking for 7 years where we're going to have interest rates at 1%. And don't forget, we had interest rates at 1% in 2003, 2004 for about a year and a half, and that engendered the entire housing bubble. So we'll have 1% or less for 7 years. And one has to wonder what bubble that will engender. So at one side of his mouth, he's saying we want to manage inflation expectations and try to keep them low. But then he's doing everything he can, really almost everything he possibly can, taking interest rates to 0%, a $2.7 trillion balance sheet, 0% interest rates for years, and then says that, we want inflation, we're doing everything we can to create inflation, but yet then we don't want inflation. So he's acting very schizophrenic, in my opinion. So that's why I don't listen to what he says. I listen to what he does. What he's doing is he's providing American investors with negative real interest rates for years. He's making sure that the dry tinder, which is known as the monetary base, is at record proportions. And he's trying to make sure we have enough money around to monetize the debt. And that's what his actions are doing. And that's why I'm investing accordingly.
And to add to some of your other points there, now, you mentioned he's trying to manage inflationary expectations, but in some of the things he said, do you also see the Fed planning further action with further stimulus of another potential quantitative easing program or a jobs program or whatever the heck they're going to call it? Do you see that coming down the pipeline in the next quarter or two?
Well, I think QE3 has already begun, because as I said before, he has a target rate of 2% on the core PCE. It's currently 1. So if one was to assume that 2 is higher than 1, you would have to also assume that it's below his target, and he's going to do everything he can to meet that target. Now, he can't lower interest rates in nominal terms any longer. They're at 0. So what does he do? He's got to expand his balance sheet. That means he's going to further attempts at quantitative easing, further attempts at increasing the size of his balance sheet, and somehow that's going to engender a higher rate of inflation. It's happened before. It'll happen again in the future.
Yeah, that's very interesting. And as bad as the inflation is here in the U.S., when Ben Bernanke creates more base money supply, more inflation is actually created outside the U.S. in other developing countries like China with their dollar pegs and part of the currency wars. That inflation is then dispersed in those economies, and then because of the U.S.'s trade deficit, we end up importing even more inflation back from China and India in higher priced goods and services.
Bernanke doesn't force anybody to peg to the dollar. That's their stupid decision. The Chinese have relaxed that somewhat, but if another central bank decides to peg their currency or to recycle their current account surplus into U.S. dollars, that's their decision. But I'll tell you this: I can assure you, Bernanke doesn't. And he's a very smart man, but he doesn't understand what causes inflation. He truly doesn't believe that any increase in excess reserves, which is basically what he does when he blows up his balance sheet, he creates credit and buys a bank asset. The bank asset resides with the Federal Reserve as an asset. That the primary dealer has an asset which is an excess credit. He doesn't believe that excess reserves have anything to do with money supply or inflation. He believes that excess reserves don't affect the value of the currency. So in essence, what Mr. Bernanke is saying is that people who look at a currency, or the U.S. dollar specifically, don't ever look at the size of high-powered money, which is the monetary base, which is physical currency plus reserves, Fed credit. So if we don't look at that, then we can't make a judgment as to the value of the currency. He's completely wrong. When I look at the value, what is the future purchasing power of the dollar, I look at real interest rates, I look at money supply growth, and I look first at the size of the monetary base, which is the building block and the basis for all money creation. And how can I or any other intelligent person look or try to assert the value of our dollar and ignore the size of what causes the dollar supply to increase, which is the monetary base, which increased from $800 billion in December of 2007 to $2.7 trillion today. Bernanke ignores that. He believes that we ignore that, investors, but we don't. And that's why the price of oil went from $33 a barrel to $96 a barrel today. That's why copper's at $3.70 a pound. That's why gold is at $1,700 an ounce, silver, etc. These are why all these commodities are skyrocketing and holding their high watermarks, because they are serving as an alternative currency. Bernanke doesn't think what he does affects the value of the currency. He's dead wrong.
Yeah, and that's a very good point, Michael. And the real U.S. economy, like not the capital markets, but the real U.S. economy where you and me go out and work every day, is things are just getting worse. I mean, the inflation rate is increasing. Like everything we have to use to survive, like our insurance bills are going up, food and energy prices are definitely trending higher. Consumer discretionary is a different story. And then you look at the real unemployment rates, and those are increasing too in the private sector. So what I'm seeing now in the real U.S. economy is basically worsening stagflation. Would you agree with that?
Yes, the condition is best described as stagflation. We have about a 10% year-over-year increase in money supply, which flies right in the face of Bernanke's contention. He's of the belief that he can create all of these reserves, excess reserves, and that the bank will not use them. The bank is using them. The bank is using them not to make loans so much, but they're using those reserves to buy treasury bonds, and that the money supply is growing in that regard. So the money supply through the fractional reserve system and the money multiplier effect is increasing, not because a commercial bank is using their reserves to make loans to entrepreneurs to build factories and mines and utilities and capital goods. They're making loans to the government. But the money supply still grows if you do that. And that's how we're getting growth in the money supply. And you're getting that and that means you're not going to get growth in the economy. You're going to get growth in money supply, no growth in the economy, stagflation. and that's the best word I could use to describe what we've had since 2008, and that's the best word I can come up with to describe the future of our economy for the next several years.
Yeah, I completely agree, Michael. And to add to your point there, the private sector is definitely stagflating here, but the government is still the federal government is basically still growing. They're still looking, to create more government agencies, more rules and regulations, and there are a lot of government jobs that, we don't need, especially if we're going to have a real fundamental long-term recovery in place.
Exactly. We had some, I thought, shocking data that came out earlier this week on GDP, and most people didn't even just don't even talk about it. They say we're growing at a 2.8% annual rate, but I looked inside the data and I saw that the nominal or current dollar GDP was up 3.2%. So if the economy is growing at a nominal rate, not a real rate, a nominal rate of 3.2%, that means that if inflation is running anywhere near 3.2%, and I believe it's running higher, we're in a recession. And indeed, if you look at the facts of the matter, inflation is running around 6% per annum. A lot of people don't want to acknowledge it, but if you look at the 8% increase in food prices, the gasoline prices are up around 6 to 7%. If you look at import prices, they're up 10%. Money supply growth rate is up 10% year over year. I mean, the inflation is all around you. Of course, if you do an hedonic and chain-weighted measurement of inflation, also known as the chain-weighted core PCE, personal consumption expenditure index, then you come up with this bastardization of 1%, and then Steve Leisman can run around and everybody on CNBC can run around, and Bernanke can run around and say, look, inflation expectations are under control, when in reality, normal prices paid by the consumer, consumers are running closer to, like I said before, 6 to 8%.
Yeah, and part of the thing with the CPI there is the substitution stuff, like you mentioned, is that formula to remove the inflationary components is just going to assume that we are going to substitute out and go and switch from steak to chicken to ground beef to dog food. So this is ridiculous. I mean, it's obvious that they're expecting people's standards of living to decline.
Well, this is I call this reverse hedonics, and I've talked to the VLS about it, and they seem to have a hard time understanding this. But hedonics is when they give you an improvement in your say your car now has Sirius satellite radio, and they since the Sirius satellite costs more than a regular radio receiver, they take that out of the calculation for CPI, and I can agree with that to a certain extent, depending if it's done correctly. That's not inflation; it's an improvement in the quality of your car. So, if they do that and they acknowledge that, then why not also account for the reverse hedonics that occurs when you have a variety in your diet? In your example, you can no longer or to a lesser degree consume steak, and you switch to ground beef. They can't count that as a zero increase in inflation. They just substitute that out in their chain-weighted index. But they should not substitute that out, because you are reducing your standard of living. And if you're reducing your standard of living, that cannot be considered deflation or a lack of inflation. It's a reduction in your standard of living. And if you do an hedonic adjustment, which is an improvement in your standard of living, and take that out, then you also cannot take that out for a reduction in standard of living.
Yeah, I agree, Michael, and I don't see any beneficial deflation in terms of purchasing power increases in paper fiat currencies anytime in the future. But I do see beneficial deflation in terms of purchasing power increases for holders of physical gold and silver. What do you think on that?
Well, you're stating obviously for 3,000 years or for 4,000 years, gold has been a perfect money. Actually, it is money, but it's used more today as a substitute for fiat currency, and people no longer trust and rightfully so. Since 1971, we have no redemption of our dollars for gold, and people are seeking other alternatives. And like I said, for thousands of years, it's been precious metals have served that purpose perfectly, and they can walk around and be very comforted in knowing that their savings is not losing value due to inflation. Now, gold is not an investment, I'll caution. It's a perfect way of preserving your wealth. It's a perfect way of parking your savings and your wealth. For an investment, you would have to invest in something that can grow its earnings, like a gold stock. So there's two ways of playing the precious metals bull market.
Yeah, and to add to your points there, I also think the gold is not physical gold is not tax advantaged. The way the government has the tax stuff set up for physical gold and physical silver is it's tax disadvantaged. You don't get any benefit whatsoever from buying it and holding it long term. And the government actually benefits the more inflation it creates, and then when you go to sell it, if you go and sell it through the normal legal paper channels.
Mm-hmm. Yeah, well, I mean, they're forcing you to own gold for exactly what you said. It's a negative real interest rate. So I have a choice. I could hold. Let's just take a 10-year Treasury note, which is current yielding 1.82%, and as long as inflation is running below 1.82%, then I'm reasonably happy. In fact, it has to be running a little bit lower than that because you have to account for taxes on your Treasury bond. But we all know that even as the government calculates inflation, it's running at 3.4, 3.5% on the CPI, which is a slightly better measurement than the PCE. It's a little less substitution that occurs in the CPI. It's more of a fixed basket. But their weighting is all corrupted there as well. But if I want to preserve my purchasing power, I need an after-tax real return on my investments, and that's why people are flocking to gold. That's why gold's up from $300 an ounce to $300 an ounce in the beginning of the last decade to $1,700 today, and probably going, in my opinion, up to $2,200 an ounce, thanks to Bernanke's assault on the middle class and savers and retirees.
Do you have similar price appreciation expectations for silver in 2012, or do you think silver is going to consolidate for a lot longer than gold?
I think gold is my favorite investment. I don't have the same upbeat price projection percentage-wise for silver because silver is also an industrial metal, and I do think we're going to have a very challenging economy. I'm not predicting a cataclysmic deflationary default like we had in 2008. We have unbelievable alacrity, a level of alacrity amongst central bankers to depreciate their currencies. We see the LTRO in Europe, and we see Bernanke with his QE3, which has begun in my analysis. There's no way he has not begun it because he has that inflation target, which he's not meeting. So the fear of deflation is greatly overdone. I have to caution your listeners to understand that the pathway towards intractable inflation is not going to be linear. So you're going to see fits and starts in this inflation. So, for instance, Bernanke has told us that the Fed funds rate will stay at 0% till the end of 2014 as a minimum, and that we have an inflation target of 2%. So we're going to have at least a couple of years here where risk assets are going to be in play. So you should be you own your gold, you own your silver, your base metals, your energy, your ag. They'll be your best bet. But once Bernanke is not Gideon Gono of the central banker of Zimbabwe. He still thinks that he's actually an inflation hawk. He's pretending that he has some vestiges of inflation fighting credibility. So I believe that once inflation goes, even on the PCE, eventually the inflation on the PCE will be above their target rate. So it'll go to 2, it'll go to 3%, which is almost inevitable to occur. And it's at that juncture where Bernanke is going to have to make a decision if he's going to continue expanding his balance sheet, and there's going to be tremendous pressure for him to start to drain that balance sheet. Of course, once he starts to drain his balance sheet and raise interest rates, the entire economy is going to collapse. So we're going to have huge, trenchant battles and swings between inflation and deflation, and you have to know how to invest and make money in that environment.
And I heard you in another interview, Michael, mention the barbell strategy, which is something I think is a pretty good strategy for most people to definitely consider. Mm-hmm. And for our listeners that are not familiar, that's where you have a certain core portfolio position in gold-related investments, and you have a certain core portfolio position with some kind of liquidity or cash. Can you please elaborate further on that?
Yeah, sure. So, it's wonderful to say, and I'm one of the people in the vanguard on this since 2000, the early 2000s, that we're headed for a higher rate of inflation, and you have to hedge against that. Well, that's great. So you own gold stocks through the middle of the 2000s, and you own them to 2008, and then I sold all of my exposure to commodities in the summer, August of 2008, because I realized that my model and my economics was dictating that the natural forces of deflation were starting to take over. You see, when you have decades of an increase in money supply and decades of an increase in debt, decades worth of a buildup in asset prices, the natural function to occur is for deflation, to wring out the excesses in the economy. You need money supply to shrink, you need debt levels to fall, and you need asset prices to fall. But that's politically a very hard pill to swallow. So what they're doing is they're fighting. The government and the Fed is expanding the balance sheet. Their deficits are north of $1 trillion every year, 1.1 this year and 1.3 last year. We've got 10.6 trillion in publicly traded debt, and the national debt is now above 100% of GDP. It's at almost 15.3 trillion now. So you have to understand that yes, inflation is here. Inflation is going to get worse. But if you were to hold gold stocks in the fall of 2008, you've gotten crushed. In the summer of 2011, if you were to hold the GDXJ or the GDX, you could have lost 35-40% of your money. There are times, and that was, by the way, a result of what happened in 2012, was the end of QE2, which occurred in May, I believe, when that ended. And there was a couple of months of a lag, and these commodities got crushed. So what I do is I try to identify these times when we're going to have inflation. There's times we're going to have deflation. It's not always going to be equal. Sometimes my portfolio is 50-50 on a barbell approach, 50% hedged towards inflation, 50% hedged towards deflation. There are times, like I said, in the fall of 2008 and the summer of last year, when you want to be 80-20 for deflation, which is a lot. I use a lot of fixed income. I use a lot of consumer non-discretionary. I use a lot of utilities to hedge against that, and I even short gold and silver and energy at times. And then there are times where I think, like what happened in the last couple of weeks, where I think you have to be more hedged towards inflation, because Bernanke told you, he said to you, if he was your broker, Bernanke would be telling you, hey, go out and buy some gold, because inflation is getting higher.
Yeah, and that's exactly something our listeners need to really pay attention to, is long-term Warren Buffett buy and hold investing strategy for forever. It's not a good environment to do that in because of currency instability and because of all the interventionism from the central banks.
I had a conversation with Jack Bogle at the Museum of Finance in Manhattan, along with Paul Volcker, this week, and tried to explain to him how buy and hold doesn't work anymore. I mean, buy and hold might have worked well when household debt was 46% of GDP and the national debt was 50% of GDP. But now you have household debt at 90% of GDP. The government debt is 100% of GDP. And we stand on the precipice, a very narrow line between inflation and deflation. Like I said, natural forces want to take this economy into a deflationary depression, which we desperately need to give ourselves a viable footing. And government, which is desperately fighting those market forces. And when the government steps in to a great extent, we see the resurgence of these inflation hedges. And when they step away from it, you better get out of the way, because they're going to come crashing down. And you can buy and hold gold, as many of my friends do, and you can buy and hold a fixed basket of base metals and precious metals and energy, and you'll do well over 10 years. But I think you're much better off trying to a certain extent, understand the model, the macroeconomic environment. I have a model that tracks the direction of the currency, the value of the dollar, the direction of inflation and deflation. If you can get that right, more times than not, you can vastly increase the return on your portfolio.
Yeah, Michael, and if people are going to buy and hold, I mean, they better not be checking their account value 10 times a day, because then they're going to panic sell at the exact wrong time.
Well, yeah. I mean, you have, listen, you can buy and hold certain things in your portfolio, maybe to a certain degree. But if you listen to Jack Vogel, he's a legend in the industry. He created the buy and hold strategy and indexing. He's the founder of indexing, the founder of Vanguard. And the man's a genius, but his contention is, hey, buy and hold a diversified basket of holdings, and you'll be fine. Well, since 2000, you've made 0% in nominal terms, and in terms of gold, you've lost 80%. If you did an allocation to an indexed allocation to the S&P 500, in the last 12 years, you're down 80% vis-a-vis gold. So how can one still contend after 12 years, which is a hell of a long investment time frame, that buy and hold still works? Something is broken with the buy and hold strategy, and perhaps it never really worked. But certainly today, it no longer works. And you need to have a money manager who understands economics, who understands the market, and understands what to buy in a differential of the market, what we see today.
Now, Michael, in wrapping things up, I have one last question here. I want to ask you your outlook for all different types of commodities and also China's economy, and if they're due for a hard landing.
Mm-hmm. Okay, so what do you want? Price targets? What do you want? Let me just say, I can tell you that I refrain from specific price targets. I know I mistakenly gave you one for gold, but that's public. You can contact me personally at pentoportfolio.com, pentoport.com. If you want a specific portfolio or investment advice, I will tell you this, that I don't understand one thing, Jason, and this is that most people will tell you, who agree with my or the Austrian economic perspective, that government management of an economy doesn't work. And yet these are some of the same people who will tell you how wonderful China is. And China, communist China, is a managed economy. They have rapidly growing money supply. It's a command and control economy. Now, China has many problems. The problems are not as bad as the United States, because China has a very low debt-to-GDP ratio, and they have over $3 trillion in savings in a rainy day fund, also known as currency reserves. So they're far better off than the United States. However, I don't have the ebullient outlook that China is going to have a slow landing, a very soft and gentle landing. I think they have a real estate bubble. I think their economy is significantly out of balance. I think they need to grow their middle class, but they don't have the problems the United States has. So is China immune from what's going to occur? No. China right now, they have a model where they produce and save a tremendous amount and export. and they're exporting to who? They export to Japan and Europe and the United States. Well, if those economies are mired in a recession, how upbeat can I really be about China? So China will be okay, but they will probably fall from where they were, 10, 11% GDP growth to probably around 5. And that's going to be very painful for the Chinese economy, the Shanghai index, and for certain commodities. So that's another thing you have to understand and realize when you develop your investment portfolio.
That is some great insights into China, Michael. In wrapping things up here, I just want to thank you for giving us your time. And can you please tell our listeners how they can get in touch with you if they're interested in getting your newsletter or some of your other portfolio strategies?
It's www.pentoport.com if you want to view my website. And my email here is mpento@pentoport.com, mpento@pentoport.com. Be happy to speak with people